Hello, my name is Peter Vilim, and I'm a lead advisor at Francis Financial, and I'm excited to welcome you to our July 2023 Investment Insights, where we'll go over some recent market trends and performance, and talk about some of our thoughts about what we saw and what we expect to see going forward. As always, if you have any questions about some of the topics that we'll discuss today, please feel free to reach out to us. We're here to answer any comments or questions that you might have. Without further ado, let's jump in. So June 2023 was a strong month that we saw almost across the board with every asset class except for US bonds. And this buoyed what was a very strong year in the market so far. This was a strong year, even despite a very tough end to 2022 where we saw market lows. And it really shows the benefits of continuing to stay invested and not getting too attached to any individual market sentiment, whether it's going to go up or down. And I think a good example of that is looking at the difference in performance between growth and value stocks. You can see that they're quite similar for the month, but for the year, you've seen that growth stocks have quite outperformed value stocks. And this was against the market sentiment that we saw at the beginning of the year. These strong cash flow companies were expected to outperform these growth companies that might have had a little bit more inflated balance sheets. But this is why it echoes our market sentiment of continuing to stay invested, not knowing what's going to happen in the short term. And that's how we're able to enjoy strong, diversified returns since the beginning of the year. And this is also what we've seen on a month-to-month basis. Towards the beginning of the year, we saw international stocks being the winners in portfolios, performing strong and outperforming US stocks. But since then, we've seen US stocks continue to outperform international. So you can see that the S&P 500 is up almost 16% since the beginning of the year, while international stocks are closer to about 10%. So it's all about maintaining that diversified exposure. And similar to our stance with bonds, just because it hasn't performed well in the short term isn't necessarily indicative that it will underperform in the long term. So it's about maintaining that diversified portfolio to really enjoy those strong long-term returns. So let's talk a little bit about what we've seen in the past handful of months. It's been a roller coaster in the markets, despite the fact that it is up and it's up quite substantially since the beginning of the year. It wasn't without its hiccups. One of the main points of market fluctuations was in the winter, when we saw a decline in regional banks after the failures of Silicon Valley Bank, Signature Bank, and First Republic. And people were feeling sentiments of 2008, right? Was this going to be a bigger issue? Were the increases in interest rates going to create this huge systemic issue? It turned out in this instance that it was more company specific, so there wasn't as much of a concern to the economy at large. But this is that same sentiment of continuing to see some of this negative news, see some of these things that even have an impact in your portfolio with paper returns in the short term, but continuing to stay invested through it to be able to enjoy stronger, longer term returns. And we saw something similar with the debt ceiling standoff in the past couple months, and the potential risk of US default and what that would mean specifically with fixed income portions of our clients' portfolios. And despite the fear that they wouldn't reach an agreement, they did. Continuing to fight through some of these uncertain times to enjoy those longer term and even shorter term strong returns is crucial. So seeing what we've gone through, and those are the big two ones, but there are other ones too. Continuing through a thread of last year with the Federal Reserve continuing to increase interest rates to combat inflation. And they've raised it 75 basis points since the beginning of the year. And while we have seen these increases, we've also seen that it hasn't had the mark on the economy that many pundits were fearing when fears of recession and everything along those lines, with the GDP up 2% in the first quarter. And inflation still is higher than what the Federal Reserve is targeting at that 2% rate, but it has declined, or at least the headline CPI has declined to 4%, with the core CPI at 5.3% as of the end of May. So that's a lot for our portfolios to have gone through in a very short period of time. But as we look forward and say, okay, what are our takeaways from everything that we've seen? And we've seen that maintaining that diversified, balanced portfolio has served investors extraordinarily well through the first half of this year, despite a lot of events in the market that have created momentary downward periods. With that, there's no way to exactly see what's on the horizon, but some of the things that we're looking at that may have impacts on the market in the short term. As mentioned before, inflation remains above those target levels. So while it is at that 4%, that Federal Reserve is at 2%. So we'll see how sticky that inflation ends up being. And what the impact of those higher interest rates might be. Those higher interest rates are there to help slow down those inflation levels, how long they're higher and what that will actually have on the economy, and how the increase in interest cost will have on the already high US debt. We'll see how that translates to manufacturing activity as that continues to decline too. But just despite the fact that there are some concerns in the market, doesn't mean that there's not room for optimism. We saw profit growth in the first quarter beat expectations, and that helped buoy some of the returns that we saw. Inflation was at its lowest level since March of 2021. So despite it being higher than the Fed rate, and it has been declining quite substantially since the summer of last year, and the demand for services remains strong. And so our main philosophy is continuing to stay invested according to your financial plan. Don't make decisions based on what you see with some of these flashing red lights that you'll hear in the news. Avoid the headlines and stick to the plan. While it might not necessarily feel like it's the best thing in the long term, it really is the best to stay invested and ride the downs so you can enjoy these long ups like we've seen in 2023. Thank you again for joining me today. Again, if you have any questions, please feel free to reach out to us, and we look forward to speaking with you soon. Thank you and have a wonderful day.